on this rainy and dreary day, but since this is Zoom, you actually didn't have to walk anywhere. Fairly easy to plug into Zoom. So thank you for tuning in. My name is Ala McCoy. I'm Director of Startup Support at the University of Maryland. And I am happy to introduce today's speaker, Doug Humphrey. Doug is entrepreneur in residence at the University of Maryland. He is a successful serial entrepreneur. He is also known as the father of managed hosting. He was one of the first guys who figured out how to commercialize the internet back in the day. And he has quite a few very interesting stories to tell about that, but that's later. So Doug has had multiple successful and unsuccessful companies from which he's learned a lot, and he's here to share his knowledge with you. So hopefully you won't have to make the same mistakes. And today, Doug will talk about how to divide founders' equity to keep it fair for everybody and also to keep it attractive for investors. It's a very tricky topic. So Doug.
Thank you. Thanks, Ella. I'm very happy to be here. It's great to work with all the University of Maryland people who are like top notch. And just a word of warning, I'm of course at home, so there are a bunch of dogs and an exotic bird and some other things wandering around. So, you know, if you hear screaming and screeching, it's nothing strange. It's just the bird and the dogs fighting. So let's talk about founders' equity for a moment. So you go into start up a company, and I will note that this is a little different in different scenarios. So in the academic world, sometimes there are some rules about, sharing equity in different ways and stuff. But this is a pretty good, just straightforward description of, hi, Jane decides to start a business, and where do we go from there? And we're gonna track it through and give you some flavor for it. Let's see, hold on a second. Okay, good. Okay, good. So who are founders? Well, right off the bat, we have a little bit of a problem because the word founder means multiple sort of things. And the two prevalent uses that you'll find are people will talk about the founder, singular, of a company, because not always, but in a lot of cases, there's just one person who, started the company, had the initial idea and took it forward and did really, as it says here, founder, the originator, the owner of all the initial equity. I mean, if I sit here today and say I'm going to start a company, I own 100% of it, right? The life and soul, taking responsibility for the life and soul of the company, you are the person who are not just going to be the face of the company, but you are in the beginning, the alpha and the omega, the beginning and the end. You are all of the company. And then there's the phrase, the founders, which is also both, these are not exclusive, a valid phase or a phrase. Let's say that I start the company, and I'm the founder. And after some period of time, I bring two other people in, and they're very early on in the company. I mean, we're still working on folding tables out of the basement somewhere or whatever, or totally virtually. The later on down the road, with the advantage of kind of distant sight, 2020 hindsight, all of us may very well be referred to as the founders. So they're not mutually exclusive. So types of ownership. There's equity. That's when you own a chunk of the company. If I give you 20% of the company, then here, this is equity. You own 20% of the company. Ownership is mostly a sort of permanent thing, although, as you're going to see, there's dilution in a company. So you may say you own 100 shares out of the 1,000 shares, so you own 10%. And that will, as more shares get issued, you still own your 100 shares, but now the company isn't 1,000 shares, now it's 2,000 shares. So 1,000 into or 100 into 2,000 is not 10%, it's 5%. And we have a chart on that, you'll see. But also there's something called options. And the key is that, you know, you can give someone equity in a company in exchange for a thing or whatever, something that, hi, I'm delivering, here's 20% of the company. You need to then be delivering me something, and it needs to be all delivered, not some future promise, maybe. Or you can, let's say I hire somebody and I give them shares in the company. Well, the thing is, I need them to stay around for like 3 years, let's say. So I'm going to give them options to be able to get shares in the company across that 3-year span, so that 2 weeks into working for me, they don't change their mind, fly to California and say, I'm going to be a surfer. And I think, well, being a surfer, but why are you taking 20% of my company with you to California and not doing any work for me? Obviously, that's not going to work. And I need a mechanism whereby I can then go, okay, well, okay, Bob, you worked for me for a year and you're skipping out on the last 2 years, but here you can keep a third of whatever your options were, right? So options are a way to manage the distribution of equity. Now, that said, sometimes you'll have an investor that comes in and says, I don't want options, I want equity. That's fine, because the point is that come that day when you're handing them the ownership, the equity, they're handing you the cash, and the cash cannot be taken back. There are actually investors who have, put $500,000 into a company and then come back later and gone, we need some of that back. And the company's like, no, that's not how this works. So we're going to talk a little bit, and this matches up with this next thing here, which this idea, kind of a timeline through the company. But let's go back. There we go. So you got the founder, just you, your idea, your effort, dedication. This is your baby. You sacrifice for its success. You're the one who's like eating ramen noodles, not going on vacations, not doing anything but pouring all of your work and your heart, whatever, into this. And quite often you have a day job, and then you maybe even have a night job, and then you have your startup job. So founders are the ones who really, really, really pour their heart and soul. And that's the founder and founders, multiple people doing founder's duty, and at some point, this is what I'm going to describe as a natural progression, because one person, for most companies that are developed into being multi-million dollar sort of big companies. Oh, by the way, look, this is Bento the dog. Hello, Bento. Dirty crime boy. Hello, dirty crime boy. So most of the most companies go through this company building sort of thing that we're talking about here, where one person really can't carry the ball all the way to the end and build all the value. Collaborators, these are people who come in and help run a company or help you with things. By run the company, I don't mean a bureaucracy, but sell and go do things. You have early employee, but these people also often have a day job, and they're helping you in their spare time, whatever they can afford, because they often don't come on as really employees because they're already an employee somewhere else. Our system of having health insurance tied to employers, by the way, is a terrible thing. I mean, it really, really ties people to their employer. Because that's where their health insurance comes from. But anyway, different question. Then you get early employees, people who you're bringing on, but not at market rate. I mean, this is someone who's going to come on and do programming for you, or come on and do whatever it is for you: sewing, work, design, customer assistance, customer service, whatever it is. And they want to come on full time, and you're going to compensate them because you can only afford to pay this person like $50,000, let's just say. And the collaborators, you couldn't maybe afford to pay them at all. So maybe you're paying the collaborator guys, they're keeping their day jobs, and coming to work for you during the evening on stuff, and you're paying them entirely on stock options. Whereas now your early employees, maybe they're actually able to come in as employees, but they're sacrificing on the money. Maybe on the open market, they're worth $100,000, but you can only pay them 35 or 40. And they're like, I will take your 35 or 40. I will eat the ramen noodles. But you have to give me stock options to make me whole. And then when you get into what I'm going to call regular employees. These are people who you get to the point where you can hire them for, mostly market rate, you know. And I don't mean I'm not saying that in any bad pejorative way. You have the money and they command $100,000 in the marketplace, and you pay them $100,000, and maybe you give them stock options too. Stock options are not just about giving people monetary value. They also, as you'll see when we talk about boards of directors and stuff, stock options align the interest of multiple parties so that they all have an interest in you doing well with your company. They see an opportunity. They don't go, I wonder who I would refer that to. I can't think of anybody. If they're on a board or they have some options in a company, they're going to be aware of you and what you do. And if they see an opportunity, they may be like, hey, you need to call Bob over here. Hey, Bob, call these guys. Here's a referral. They might be a fit. And, if that works out, that's great. Because again, your interests are aligned with the interests of the company. So let's look now. Um, so let's talk here on the top line. You really just have the timeline of a company, right? The idea, the thought, the development of the thinking of markets, product, possibilities, features, all those things long before you actually have a product. If you're the founder or founders, you're thinking about this product and you're writing this up and you're saying, hey, what features does it have? This would be a great feature, but that's later. This is a minimum value, the MVP upfront kind of feature set. Here's a later feature set. Oh, here's some features that we can add to pick up a different market or, some different customers. This is the idea and the thought, and this really never stops. But there's a time in the beginning where this is all there is. You wake up in the morning, or in the evening, whatever, and you think about this stuff and you write it up or you talk to people about it, you network it, you research it, you Google like a fiend, you look up patents, you do all that stuff. Once you come to the conclusion that you really do have an MVP, a small version in the thinking, now you go into development, and then you're actually going, okay, well, look, now we got to build this thing. Now, whether this is software or style and fabric, artwork, new kind of classes, better coffee, you know, whatever it is, doesn't matter. This pattern is how you take nothing and develop something. So now you're into development, and now you're, putting together, you know, prototypes, early versions, early user interface, maybe, whatever it is, an early version of, you decided that you've come up with a better rain poncho. So now, you're sewing rain ponchos and you're out there getting wet, or you're standing under the shower, you're like in the bathroom with the rain poncho prototype with the water pouring down on you. And you're going, okay, that isn't working. I move my arm, I get soaked. Okay, but that's development. That's research and development, really. It's all that. Then next thing you do, you get into production. Now, what is production? If you're an online company, then production is maybe bringing up a website so customers can come in and access your stuff. If it is, making certain widgets, here's a, cool magic widget, or, some chemical stuff, it's really tarot for killing ants, which if you can come up with a way to get rid of ants or mosquitoes, you're doing good. You come into production. How do you make this? And that's a whole nother art. There's an art and a science to production. There's an art and a science to operations. The operational arts, as we call them, So, you get into production, you get into operations. Operations is where you have to run things continually. Um, these are kind of the phases of companies that start. And sure, once in a while you find exceptions to the rule, but generally speaking, if you're starting it from nothing and go into something, you have to go through these phases. So let's talk about the people that's on the bottom here. So if you have your idea, your thought world, you have founders, you have multiple founders, kind of a hybrid model like that. You'll notice that overlaps in. You have collaborators that are also really part of that thought process as well. I mean, you can bring on. Well, we talk about boards, by the way. You're talking about like a board of directors, which is a legal requirement for an incorporated body. And then you talk about a board of advisors. And that's not a legally mandated or required thing. Your board of directors, very simply put, are the people who are going to help you run the company from the CEO, president, whatever, top dog. She needs to report to someone. He needs to report to someone because it's really, really lonely at the top, and it's hard to make big decisions without having someone you can a mirror, someone you can bounce stuff off of. And all the people who work for you, they're not that. Now, some of them may be that. It's possible that you can have people who are able to both be employees and workers and working in things and managers and also give good executive and strategic advice. But it's moderately rare because you want someone who can give you advice as an equal, and tell you an ugly truth and disagree with you on stuff and say, I don't see it that way, and I don't think we should do this. And then in the end, a board of directors votes on the big things. Let's say you want to spend a huge amount of money on something. Let's say you want to merge with a company. Let's say you want to make a couple of big critical hires that are going to be really the future of the company in many ways, are going to be critical to it. As the CEO, as the president, as the founder, as the person in the hot seat, as the person who is running it all, you want a board of directors who can give you, solid, unbiased, unvarnished business advice and say, no, John, Jane, can't be doing it that way. We need to, we only have so much money. We can't spend it all like this. And who can vote and will vote against you. Um, Board of advisors is much more people who know your industry, people who you're going to consult with on development or consult with on production or consult with on maybe even in operations, depending on the company. Those are the board of advisors. That's a role that is a much more fluid role and is more about giving you advice and connections because they don't vote on things and they're never put in the hot seat to say no to you. But the board of directors is the CEO wanting to have feedback, pushback, someplace to, you know, not be lonely. These will be your best assets. And in a weird way, your best friends, even if they're not personal friends, but in the company, in the corporate world, you running your stuff and having responsibility for all these people who work for you, you come to the point where at 3 o'clock in the morning, you know, and you can't sleep and you got this big decision, it's your board of directors that gets phone calls. And, it's their job to take them. And it's their job to sit there and hear you out, talk frankly to you, give you the best advice they can. So, so collaborators, like we said, early participants, they can come in pretty early, actually. There are people who you may call for advice and stuff. Early employees and then employees, you can see down here pretty much the span. Um, so let's go through a scenario. I'm going to read it because I have a script sort of thing, but I'm going to read it to you guys. And I'm going to show you the cap table. Now, cap table is short for capitalization table. And what that just means is, hey, who owns what here? You know, it can be tough to keep track of that, but who owns what? So let's go through a timeline. So there's somebody named Jane. Okay, I'm going to start reading this. Jane is the founder. Jane has an idea. She has a day job. She stews that idea around in her head for months or weeks or a year or whatever. And she's thinking about all the different parts of it. Like I said, how do you approach it? Who are the customers? What are the benefits? Why is this better than what's in the marketplace itself? Who benefits from doing all these things? How do I make money at this? What's my pricing? She decides she wants to do it. So she starts, does her research, the thinking. She thinks about who the typical customer might be, overall market for the product, how many people there are who might want this size of markets. She thinks that if someone else, she questions, is someone else already doing this or something similar? And that's not always a bad thing if somebody is. Being the first person to do something brand new is both exhilarating and hazardous, and it's a long road to hoe, and sometimes if there are a few other companies in there already doing stuff, they've already made a lot of markets for you. So Jane is doing all this work, and she meets David at an event, and they talk about their shared love for this industry, for doing this kind of stuff. David is, a kindred spirit on this stuff. He has been thinking about doing stuff with it. He loves it, etc. And she sees that he would really be a help to her, right? He's maybe got strong points that help with her, less strong points. It's two people rather than one, which means twice the horsepower you can put down on a problem. She asks him if he wants to come on board. Both of them are working in their spare time. David is working to help her, building the prototype, putting things together. He's not CEO. He's not taking over for her. None of that. This is her company, but she's decided that the second person of the company, her first hire, is this guy. So now he may not be coming on full time, but he's working like a dog. I mean, founder level, whether he has a day job, not whatever. So as you can see in the cap table, Jane says to David, look, 30%. I'll give you 30% equity. Now that's a huge stake, by the way. You would only do that if you had truly found your co-founder, Now you might say, well, why wouldn't you do 50-50? 50-50 is very bad, because if you have 50-50, then you have a built-in deadlock, a tie on everything. Someone has to lead. Someone has to be the person that in all the cases, in the end, when all the shouting is done, someone is the person they're following. That's leadership. Teeny little company like this, just to start, desperately needs leadership, because the worst enemy of this company right now at this moment is simply confusion, lack of leadership, stagnation, failure, no momentum. Where there's no momentum, it is critically important that someone lead. So Jane says, look, you're the other person on this one, 30%. David is like, yes, you got it. Okay, so there you can see starting point, 100%, 30%. And then the A, now these are not rounds, but these are, every time there's dilution, I put up a different column. So A, B, C, D, E. David comes in 30%, and 30% of Jane's 100% drops her to 70%. You can see it right there. Okay. So Jane is rolling along. Jane realizes that she needs a little extra bandwidth here, and she puts together some boards. So she gets two other people to join her in the board of directors, because the board of directors should always be an odd number, 3 or 5. There are only in special circumstances is a board ever other than a board of directors, other than 3 or 5. We can get into that. It's a whole thing. And then she puts together a board of advisors, and that's 3 people other than her. And just for sake of argument, each of them gets 1% on a vesting. None of these, except for the money things, are actually just boom equity. They're all option plans, except for Jane. Jane, when she starts out her 100%, she has 100%. There it is. So the boards get done. That's a total of 5% dilution. and you can see 5%. So that's the B column. So everybody previously gets knocked down by 5%. So David is down from 30% to 28.5. Jane is down from 70% to 66.5. Now in the story, they do all sorts of good things. They get prototypes out there. They have, 4 prototypes in 4 different companies. One of the companies gives it back. Then, they're working it. They have companies with their prototypes, and it's a lot of work. And it's eating Jane and David alive. They're not able to do hardly anything in the way of new anything because these early adopters of their stuff are eating them alive. So all of a sudden, they decide, well, one, they need to get a little money. So they do what we call a friends and family round and you can see it on here, F and F, 20K, 5%. These are the kind of rounds where there's not some sort of rigorous valuation. There's just sort of a 5% feels like a good number for $20,000. So they go to their friends and family. There is $20,000, 5% dilution. That's column C is in Charlie. And you'll notice, okay, the boards go from 5 to 4.75. David has dropped down to 27%. Jane is at 63.2%. Again, dilution. Every time you issue more stuff, everybody gets diluted. Now they run into Wanda. Wanda turns out to be the answer to their prayers because Wanda understands how to take care of those beta customers and how to work on user interface and documentation. They run into this woman and she's like, look, you guys need to go run your damn company. I will take care of these 4 customers and I will not be a narrow definition of that. I will be a broad definition of that. I will keep all these customers off your tails so that you guys can keep doing new product and keep expanding and finding new customers, etc. And they look at that and they say, wow, that'll let us get back to running our company. That would be really good, So they do a deal with Wanda for about 15% of the company, Now, right off you might say, well, let's look 15% for Wanda right now. And David got 30%. But now think about this for a moment. If you come over to column C or D, you can see that actually David is 30% is down to 23% now. And Wanda's at 15%. That's column D, right? So the effects of dilution are showing here in that, David and Wanda are actually much closer to getting the same amount than it really looks like over here when you compare that initial David amount. Dilution is a running thing and it happens over and over and over and over and over. Okay. But you may look at it and go, wow, that sucks. Hang in there. It does work out. So there's Wanda at 15%. Great. They're going gangbusters and they're going to raise more money. So they go out and they work it and they present to like 20 different investors, 30 different investors, and it all comes down to 2 investors actually put what's called a term sheet on the table. Our term sheet just basically says, we will invest in your company. Here are the conditions. And most importantly, here's the pre-money valuation, which is what we think your company is worth right now. And by the way, you'll notice it isn't, oh, this could be worth billions. It's like, no, but it's not worth billions. Down the road, maybe, well, we all hope. But right now, you're going to raise $500,000 on a $2 million pre-money. And that means they're going to get the way you calculate that is the company's worth 2 million and then it has $500,000 in cash. So now it's worth 2.5 million. And then 500K on 2.5 million, that's called the post-money valuation, gives you 20%. So the A round happens and go to column E, 20%, you see. So now Jane was at 100% when this whole thing started. She's at 43. David was at 30, he's at 18.4. The various board seats are at, 3.4 total for all 5 seats. Wanda's down to 12%. But now that you have money coming in, you can actually do something called an evaluation event. This is, you know, if you go to column C, well, friends and family, but you didn't really want to couldn't put a value on things easily. But now the venture capitalists or the professional investors have come in and they've had to value the company in order to do the math. So let's see what we've got. So Jane is down from 100% down to only 43%, but at the valuation of this first round here, Jane stock's worth $1 million, and David's at 460,000. The board is at 80 grand, but you divide that by 5, so 16,000 per seat. Friends and family, they put in 20. Their stock's worth 85 right now. That's not bad. And remember, there's no liquidity going on here. You can't look at that 85 on the 20 and yay, let's sell it. It doesn't work that way. Not yet. Wanda, 300,000. That first round of money, well, 500,000. So, that's what they just put in. So everything goes well. We're going to say another event happens here. Rather than getting into pricing, every single employee that comes on, you're going to do something that's called an option pool. And that just lets them in, because every time you actually have to change this cap table, you have to go to the board of directors. There's some work involved. So what we're going to do here, and this is very, very common, is right after that first investment, the first big one, don't count the friends and family for this, you form what's called an option pool. And you go to basically the board and the investors say to management, look, you're obviously going gangbusters here, and you're going to hire, you're going to hire another 20 people, 15 people, whatever it is, What do you need in the way of options in a pool that we pre-authorize that you guys can just, bang, 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 you can go do what you got to do, And, 20% is not a bad number, so there it is. So there's a 20% option pool. Everybody gets diluted by 20% again, including the guys who just literally the same day probably put money in. But okay, so now some time passes. You've hired 10 people, 15, 26, I don't know, whatever, and you've gone gangbusters. You've got customers, you have revenue coming in, you're doing things. It's time to raise some real money, because you have handcuffs on, you're shackled, because you only had $500,000 in cash. That's probably all gone by now. So you're a very successful growing company, but if they don't water the plant will die. It's not, so you do a B round. Let's say it's $2 million, and you're let's say that you're they say $5 million pre. So you were worth $2 million, and now they're like, well, we think that you're worth $5 million now. So raise 2 on 5, 5 plus 2 is 7, so it's 2 on 7. Comes down to about 28%. Now I'm going to tell you, you'd like to do better there. You'd really like that to be down maybe around that 20% mark, but I'm not trying to paint a rosy picture here. Sometimes raising money is hard. You got to pay a little more. So there it is. So the money comes in. There's a 28% dilution for everybody on this thing. But let's go to that last column now and take a look. What do we really have here? We have, so Jane started at 100%, but she's now down to 24.8%. But it used to be $1 million here, and now it's 736 million. So, her value in the company, if the company sold tomorrow morning for this valuation, which is a huge if, but we would have to get to what's called an exit event for you to actually figure out what all your stock is worth. I had a company that we actually took public. I started out owning 60% of the company, Digex, and I ended up like 12 to 13%, at the end when it went public. But, that was probably worth 16 million or something, whatever, $16 million. So, the slices of the pie are getting smaller, but the pie is getting much bigger. So Jane is here at 1.7 million. David at 30% is now down to 10% of the company, but that's $740,000. And you can run this down and take a look at it. Your friends and family, where you conned your family into putting money in at 20K, is now worth 137K. It's not bad. Wanda, who came on fairly late at 15%, she's down to like 7%, but that's $483,000. So as you can see, the slices of the pie are getting smaller, but your value, assuming that things are continuing to go in the right direction, which is that every time you're raising money, you're worth more as a company as you're raising the money, you're doing pretty good. And that's what a cap table looks like. And that's really, the cap table reflects the financial truth from an investing perspective, from an equity perspective, who owns what. Now, note that all of this is assuming just straight equity. There's another, if these are options, then all of these ownership stakes actually in any given moment are less than this, because these are committed over time, right? Jane may still own, well, the bottom line is, if Wanda has a 3-year deal and quit after a year, she'd only be getting 5%, a third of this 15% here, which means she'd be getting a third of this and a third of this. So, but this is how a VC or somebody wants to see the initial cap table, because this is clear. I mean, it's like, look, this assumes that all of our commitments, run to the end and get called, and boom, we have to pay. Let me put that there. Hold on a second. So that's about it for this. Let me maybe get out of screen sharing. Hold on a second. I'm moving my cursor around, but things are confused. So does anybody have any questions? Hey, Ala, you can maybe, if you want to, take it back and run the whole Q&A or whatever we want to do.
So yeah, thank you, Doug. That was a lot of information. And so does anybody have any questions? You can either raise your hand or you can submit your question via the Q&A function.
Hi, can you hear me okay?
Yep.
Hi, Ashok Kapoor, Hawkeye MedTech. Thank you so much for this great presentation. I've always been looking on trying to decide on what type of equity is good or not, and that's what I wanted to ask you. For David to initially come with 30% equity, what did he bring to the table to earn 30%, and what kind of decisions should you make to do that? And secondly, when Wanda came, she came as an employee and she demanded 15% and got 15%. That to me is a huge chunk of equity to give an employee. So that's kind of decisions I wanted to see. How does one make these decisions? How do you give out equity so cheaply?
Well, here's the thing. So let's take Wanda for a moment. Wanda did not come on as an employee. My presumption there is that Wanda is coming on as sort of the rare beast of, that you're not paying her at all, probably. I mean, you notice you only raised what, $20,000 in that friends and family. So you don't have money to pay Wanda. That's money to keep the company going. So Wanda is working for free full time. And I'm going to figure that Wanda's putting in 10-hour days at least. So beyond, to a certain extent, if you're expecting to get a large chunk, you're not an employee. You're far, far more than an employee. you would need to be something that people down the road, if the company is successful, people down the road will look back and say you were a founder. You're in that group of founders.
Right.
And you worked like a founder. You're not an employee. This isn't a job. This is your life.
Mm-hmm.
And so you go to David, and the presumption with David is that, David has a day job because you're not paying him any cash. Cash is king. There is no cash. At the point where David came on, David, if David came on a week after Jane had the idea and they both worked equally, then you would probably actually call that like a 60-40 split.
Mm-hmm.
But I'm figuring that Jane worked on this for a year or half a year or 6 months, in her head and on paper, and maybe designing stuff. I mean, it depends on what the business is, how much you can do with individual effort without any external funds or resources. I mean, if you're a songwriter, the most tragic things you ever hear are songwriters who lose their notebooks and don't have a backup copy, because they've done all this amazing, stunning, maybe, who knows, but, intellectual work and have put it all down and then lost it. Well, that's what Jane is doing, Jane is doing the intellectual work, the homework, the research. When you go to Jane and Jane says, I've been working on this for 6 months, she better have more than just, a 2-minute spiel on, I have this great idea to do this.
Right.
Okay, that's great, but that isn't going to get anybody anywhere. If she's been working on it for 6 months, I expect her to have a marketing plan. I expect her to have marketing analysis. I expect that she went through I-Corps. I expect that, she knows tomorrow morning who she would be selling this to if she had this to sell, and what it would do and what it's going to take to make it work. And she may not be right on all of these things, down the road. These are all aspirational. No, that's not right. Suppositional. No, you are making assumptions, and then as you work, you work those assumptions out. So she runs into David, and David needs to basically be another one of her. He needs to be a founder. He needs to, 10-hour days. He needs to sacrifice. But the things that you expect from him are a little less than the things you expect from her. As the founder, you expect her to put every dollar she's got into doing this stuff, if she's got any. You expect her, oh, we have to have this or we're screwed. I guess I'm going to go give blood. That's what you do. And maybe David probably joins her in giving blood too. Founders can do that. So these aren't employees. These are co-founders. And co-founders are the people that you give a chunk to, because multiple things. You need to align interests. From a practical perspective, who's the one person who can screw Jane over the hardest? Answer, David. Because he can leave, and she's counting on him staying, and he can go start a competitor because he knows her inner thoughts on this, and he is co-founder. So this is not quite hold your friends close and your enemies closer, but what it is recognizing that, if this is the person or people who you are in this with, they need to stick, and you need to compensate them appropriately. If you get to the end of this, the finish line of this, and you still own 80% of it, you've done something horribly wrong. Now, you might say, no, I've done something horribly right. It's like, yeah, but you'll never get to the end of it if you still own 80% of it.
Right.
It won't work.
So how does one decide? I mean, they said, how did they come up with that David ended up with 30%? Just because he demanded it, got it? Or there is, because I'm trying to see if there is a formula around. There is no formula. Do you do 10%, 15%, 30%, 40%? How does one come up with a?
I think. Well, let me put it to you this way. No. There's no published. This is not mechanics. There's no, published table of delusional, of what you offer. But you will find it in literature sometimes where people, opine about it. Bracket it up, you know, it's this guy. So I go into a party, and I meet this guy, I meet this girl, and, we're doing the Vulcan mind meld, I mean, oh my God, they get it. They completely get it. This is the person who I need to work with on this damn thing, Well, then I need to look at their situation. I need to go, okay, I'm in love with this, but, I think this is the right person to work on this with me, but can they actually do it? I mean, if they've got a mortgage and they got 4 kids and they got all this stuff and they got a day job they cannot quit and this and that and that and that and that, they may not be in the position to deliver the way I need them to deliver. By the way, you have to be a hard-hearted bastard sometimes in this stuff. That's part of your job and your burden as the founder. You have to be Mr. No sometimes, and it hurts. It's a really lonely job. So right off the top, you've been doing this for a few months of putting together, and you run into someone. So let's ask some questions. Should they get more than I get? I don't think so. So that means no more than 50%. Should we have a 50-50 tie? No, don't do that. You need to establish leadership. You need to establish your position. Let's call it 60-40. Should they, so now they're getting 40%, Well, should they only have 5%? That doesn't meet the smell test, does it?
Right.
Because if I had 95 and you had 5, are you going to work as hard as I am on this, without ever thinking back to yourself, man, Doug has 95% of this thing and I only have 5% of this thing. I don't think that's going to work. The reason why there's not a set of numbers is because we're human and it's all humans and humans are squishy, So, the number is 10% okay? Man, well, 10% would be pretty good. But again, if it's just you and me, now that's a 90-10 split, well, maybe, but let's decide, how hard are you going to work here, So if you come to me, we said we meet, we talk about it, we think about it. You come back to me and you say, listen, dude, I'd cut off my left arm to work with you on this project. But it's not working for you. It is working with you. And for that, I need a big chunk. Because I got to explain to everybody why I don't go on vacation anymore and why I'm always poor and why I'm only eating ramen noodles and why I quit my promising job over at so-and-so. In short, I'm going to start acting like an idiot to a lot of people, who are not going to understand starting a company. And I'm going to put all that commitment into you and me doing this and getting this right. How much is that worth? So that's the discussion you're having with David. You're having a discussion that says, he's going to commit the next few years of his life to doing this, just like you are. I'm guessing a third is probably not a bad deal. Could be a quarter. At what point do you, as the founder, start feeling bad that you're taking advantage of the guy? Because this isn't about negotiating the hardest bargain you can get. You're going to hand this guy a loaded weapon and turn your back on him for 2 years. So, I want somebody who, here, you have a gun, I have a gun, we're back to back, us against the world. How much do I pay that guy? Because that's what it comes down to. If they're going to be a founder, if they're going to be one of yours, and you're going to be one of theirs, then that's what you're doing. So, I'm figuring somewhere around a third is probably pretty good. A third acknowledges your power and that you started it, that you got more, and that you're the leader. But it also says, yeah, but I am the lieutenant. I am the number. I'm Picard, but you're number one. Make it so, and and then that's the team making it go. and you're going to have more than anyone else. Basically, yeah, that's kind of a perk of the timeline. You know, the more risk you take, the more in this world you get compensated for taking risk and taking responsibility. Your responsibility is ultimate here. You know, I mean, the early people. So that's why maybe a third. Third's probably good. I wouldn't go down under a quarter, because then I'd be wondering, you know, and I think that they would be wondering. What you need is a number that allows you to put the whole question of who owns what aside completely and never revisit it. Whatever. We need to build a company. And then Wanda at 15%, that's a pretty good chunk, but I'm assuming there that literally she's the last of the founders. You know, she is coming in. And actually, you know what? You know, the assumption on Wanda is that Wanda is a miracle, you know, just like David was sort of a miracle. That Wanda, you just happened, you know, to go into and find, you know, someplace and get introduced to someone who has run these kind of programs before and is like, look, I will allow you to, I will take care of all of it over here. I actually know what I'm doing. I've done it before, and I'll let you guys turn your backs on this mostly, because if you focus down, a lot of companies get their product into some beta testing or early adopters, and they think, oh my God, we win, you know, and then those early adopters literally grind them into dust, trying to support those, you know, that trial, that beta, you know, questions and this and that and every single thing that goes problem, and there's no documentation, and my people can't use this, and this UI is too confusing, and you know, your product is crap, da 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 da, you know, you can get really beat up. And the founder, once you start raising money, you actually never stop raising money. You never stop. And everybody's like, you never stop raising money until what? You know, it's like, no, you never stop raising money until you IPO and you hire someone else to replace you when you retire. You never stop raising money. So the CEO has a lot of stuff they have to do. And I'm assuming that Wanda literally is like the trifecta, you know, she's the third wheel, the third piece that comes in, you know, and probably allows Jane to be the CEO and do those external things she needs to do, allows David effectively to be the COO, Chief Operating Officer, and do the internal things that he needs to do, like development, operations, hiring some people, revenue, selling, although selling is probably Jane and David, because selling is king. Everyone has to sell. And then Wanda comes in as the person that's like, you know, all this stuff that's killing you guys, I can do this stuff. I can make it happen. Maybe Wanda would only get 10%. I'm not sure, you know. But again, you know, you're asking yourself, it's squishy, you know. How good is this person? Give you an example, you know, in sports, you know, in football, a wide receiver is a very wide range, but it's sort of pricing like this, and a running back is sort of pricing like this, and a quarterback is sort of pricing like this, you know. So Jane's a quarterback. She starts off with the whole company, you know. But guess what? If Jane is just standing there when you snap the ball, Jane is dead meat. Okay. So Jane goes, I need an offensive line. And, you know, I got to survive. Oh, maybe that's David. Okay, you're the offensive line. You keep him off me. You know, and then I need to go on the offense. Oh, shoot, I have to throw the ball. Okay, I need a receiver. And maybe Wanda's a receiver, you know, and you try and price this stuff out a little bit. Hey, Ala.
I hope that, Ashok, I hope that sort of answers the question.
Oh, amazing. Yes, that clarified it. You know, it is wonderful to have this explanation.
It's a little,
so much clarity.
It's a little squishy, you know.
Yeah. So we have another question. Let's see. It was from Alex. So Alex Wang is asking, he has a question about tax. So for example, I am Wanda and received the 15% equity. Because the startup is not officially on the evaluation round, how should Wanda manage tax reporting, or when, for example, until the startup enters round Series A and such? So That's a good question.
Excellent. Okay, man, how much did we pay Alex to set that question up? That's what I want to know. Alex,
He's very
your check
smart.
is- yeah,
He is
your
a very
check is
smart
in, your
person,
check
yeah.
is in the mail. Okay, this brings up an interesting thing. Valuation is really hard, and anybody who's done these deals will know exactly what the hell I mean by that. Valuation never gets easier. So there's a great thing in the taxes called an 83B election, and that's 83B as in boy election. So what you want to do as a startup is you want to make it easy on your people. So what you do is you issue, there are a couple ways to do it. Of course, if you just give them stock up front, as we said, you have this problem that you can't get the stock back. And if after 6 months they decide to go off and play surfer dude, guess what? You're screwed, and you don't want to do that. So that's why you do an option plan. In a normal option plan, they would vest into the ownership of the shares. Okay. So, a third of 1 year down, or monthly, probably, sometimes quarterly. And they would just get their pro rata share. Pro rata just means, the equivalent share, of their option plan every month. So, and then if you fired them, obviously vesting would stop and they would only have the piece that they were entitled to. Okay, but the 83B then addresses your question directly. That is a reversed option vesting plan. So day one, they get all of their shares. So day one, Joe gets 36 times whatever his monthly amount would be to vest in a 3-year plan. So let's just say let's say it's 30%, boom, 10% per year. But the company has contractually a right for what's called clawback, to take back and shares from his plan. And the clawback then unvests monthly for the company. So what happens is day one on a 3-year plan, 30%, you get ownership, if you will, of the 30%, but it's restricted ownership. There's a little caveat next that says, but it's subject to this clawback. And day one, I have the right to claw back 36 months worth of that stuff. So if you worked for me for less than a month and then you quit, I could go, hi, I'm taking all the shares back. Have a nice day. Because you had them, but I had the right to take them all back. But let's say you work for 6 months. Well, in those 6 months, I would have lost 6 months worth of clawback. And so you then, as you left, I would exercise it. I would take back all but the 6 months. Now you might say, okay, tomatoes, why does that matter? Here's what it matters. It means that you can, when you file the 83B election, you get a letter from your lawyers, or the company lawyers, that say, hey, here's what the company is valued at right now. And we think this is a fair valuation. And for a startup like this, it's basically zero. But, let's just say the whole company's worth 20 grand. You pick a number. Well, then that's what you pay in advance to the IRS to say, hi, we're giving this person this option, and this person is using this election to pay today in advance to the IRS all of the taxes that are due on this transaction. And since they're getting 30% of a company that's worth $20,000, they're getting the beneficial ownership of, whatever that is. My brain is not working. It's teeny number. And then what is the tax on that? It's a very teeny number. And you end up sending the IRS a check for a few $100. And then you're done. You paid the tax on all of that, all the way out to not even a valuation event, but an exit event, a liquidity event. And guess what? If you actually had a liquidity event, then you can afford to pay the taxes, whatever might be due on the difference. Now the difference will be the total number. But what this keeps you from doing is, as you go through the years, having to somehow have the IRS say, we think those options are now worth this because look at this valuation event that occurred. And, you need to send us a check, because you can reply to them, no, I already sent you a check for all of it. And that check was $135, but that doesn't matter. You're compliant. So that's why the 83B election with a reverse clawback, it sounds like a lot of words, but that was put in place so that you can do this sort of option plan and avoid putting your employees into bad situations. Now, you still have to do dodging on something called AMT, alternative minimum tax, but that's probably not a real issue for you in these early days. Now, I have had some friends get into a lot of trouble on AMT though, so you have to watch out for that.
So we are at time. I'm not sure, Doug, if you have a few more minutes to answer any more
I'm okay.
questions.
I'm
And
okay.
if you guys want to stay, and Alex says, thank you, Doug.
I see. Hey,
Whoever wants
no
to
problem.
stay to answer additional or to hear answers to additional questions or to ask more questions, please feel free to do so. Or I know we are at time, so we can end, but I know you, so we have a few more questions here.
I'm happy to handle more questions. No
All
trouble.
right, thank you, Doug. So Caroline Chen is asking, if one of the founders decides to call it quit, what happens to their equity share?
Right. So again, this is why you do, so you could actually do a thing where even Jane, as the first founder, you could actually have Jane have options as opposed to owning the stock outright. You could do that. I've thought about that. I think I did that with myself in one of my companies. I don't recall. I think I did. And I mean, you could do it, but you're kind of hoping that the person who's starting the company is not calling it quits, right? And you'll notice that all the others, they all have these clawback options for the things I just discussed. So I think those things will protect you from this, protect you from having core people just quit. At the very, very, very earliest stages, if the core person quits, you may be toast anyway. I mean, it may just mean the end of the company and the dissolution of everything, because in the very, very early days, so much counts upon leadership, personal leadership, and professional leadership of the person or persons who really got it going. Now, in a more academic environment, if you have a founder that's really, really is 3 or 4 people as a founding team, you can probably suffer the loss of one of those people, as long as you have other person or people who will rally to the leadership role. Leadership, and again, we should do a class on leadership. Leadership is a very, very odd thing. No one really teaches leadership, at least certainly not at, any primary level. You can find, I think, workshops and stuff like that. But leadership is about really getting people to do stuff that they probably wouldn't do if they really thought about it and didn't have somebody convincing them to do it. And leadership for ill is a very bad thing, but leadership for good is a very good thing. And one of the reasons you have your board of directors is to help you make sure you stay on the path of leadership for good, and maybe not leadership for nothing but personal gain, or leadership for, less wholesome, goals. So does that help at all?
Let's see. Yeah, and we actually have a follow-on question from Caroline. If there are 5 co-founders to start the company, how should they divide the equity? Should one of them have the majority share to lead the company? I think you've addressed some of that, so maybe if you could give us like a very quick overview.
Okay, what I would do, okay, let's say, you have 5 people who've all gotten together to start a company. What I would actually do at that point, and I think that this is, we come to when we first started, we talked about having a founder and then founders, right? If there's no clear founder, as if one does not clearly stand above all as, I'm careful with the word deserving, but truly as deserving of the leadership role, or if it's unclear how that happens, because I think what you're going to hear is not that 5 people, all of whom are great leaders, have decided to come together to do something. I think what you're going to encounter more is 5 people with widely diverse skills, all of which are really important for doing this, have decided to come together, And I would actually draw up a matrix and start assigning, in the matrix, do an analysis of these 5 co-founders and say, okay, here's Joe and here's Jane and here's Bob and whatever, what is Jane going to do? Is leadership a key? Is technical management a key? If we're dealing with sciences, is Jane a principal investigator? I mean, is she a PI on this stuff? Very, very, necessary role. Is, Bob really working on the product, and as just not knowing anything more than the group of 5 and saying, how do you divvy it up? I don't know, good question. Everybody gets 20% and when we all live happily ever after, except for the fact that, guess what? No, we don't all live happily ever after, because the compensation that you've assigned to everybody in that case has nothing to do with what they're really going to do. And so you're going to run into huge roadblocks and bear traps down the road for this. One of the keys is, are all 5 people going to put the same time in? Oh, well, I'm a professor here, so I can't put that time in, but I'll be an advisor. Okay, good. How about you, Bob? I can put, I'm a TA, or I'm a this, I'm a that, I can, a postdoc, I can put 8 hours a day into this, excellent. Check mark there, You don't compensate 8 hours of work commitment for like 4 days a week, assuming that they really can do it, with, well, I have a role here doing other things, so I'll be an advisor. These are not equivalent positions. And if you compensate the 2 of them identically, you're not going to have happiness long-term. Because the guy who's doing advice, there'll be like weeks and weeks maybe where you never even talk to this guy. And this other guy over here is going to be turning down, telling his girlfriend or his wife or her boyfriend, honey, I can't come to this. I don't want to, I'd love to come to your concert, but I got to hack this code out, or I'm in the lab and I got to work this reaction out, and I got to babysit all the mice. I got to do this stuff, I can't come to your thing. I can't do this. And, there'll be this amazing frustration. They'll say, well, I got 20%. That's great. But, this guy over here's got 20%. We haven't seen him in 3 months. He says, oh, I'll connect with you with some people. You know what? You put that guy in your board of advisors and you give him 2% or something, So your real question is, you have to differentiate this and bust it out and figure out who is really making what commitments. And if they do not deliver on those commitments, then the deal has to change. Good.
Thanks, Doug. So Alex Wang has a follow-up question for you. I paid him again.
Good. PayPal.
When I got 30% or 15%, probably on stock option or with or without 83B, do I have 30 or 15% voting power? Or do I have to wait for my options to vest?
Okay. If you did it in an 83B, technically speaking, you have voting power because you own the shares upright. You own them outright the first day. That said, generally these things are structured so that the options and what I'm saying here is cast in tapioca. You can do this, you cannot do this, do whatever you want. There are generally different classes of stock. So what you can often have is common stock, and common stock votes. That's a voting. That is a normal share of stock in a company, which is about as compliant with what the general lay public thinks about how stock works as anything. Common stock, generally common stock votes, one share, one vote. That's the way it works. So often though, you will have options be a different class of stock because many many option holders, you don't want to have voting in the company, because they're not leadership in the company, and that's how it works. All of that VC money that comes in, that stuff is probably a different class of stock. It's probably not common. It probably does have the vote because they would like to vote, but sometimes it does not have the vote. Give you an example. There are government programs or even some large company investing programs where they put money into things, where they don't want a vote, okay? Because, they realize that they're just a small amount of money in the pool and they don't actually want the liability that comes with the concept and the overhead that comes with the concept of voting, right? Different classes of stock can have board seats or not have board seats. So your VC guys, when they come in, they're going to say, oh, here's here's how the money works. Oh, and we want a board seat. And, you go, okay. And that's where your first guy, so that's why I said boards are always either 3 or 5. They're always an odd number because you don't want a tie vote. And if you have 3, then let's say you're the CEO, you're on the board. I recommend that. And then you have 2 other people. Well, you could ask one of them to step down so that the VC guy can put their person on the board. And that works sometimes to keep the board at 3. Or you could say, okay, well, the VC is going to put someone on the board. That makes it 4. But we really want it to be 5 because 4 is a bad number because you can get tie votes. And then you say, and usually the VC will say, okay, so what we're going to do is we'll put someone on the board subject to your approval, founder. And then the 5th person will come onto the board, mutually agreed upon by us. So, which they really don't care that much. They just want to have a veto right in case you go, I have this politician who's a great friend of mine. I want him on the board, and the VC, you're going to be like, no. That isn't happening. So, it depends on how it's structured. Also, the other thing is people need to, and one more comment on that. Stock ownership and voting only control things if there isn't some other thing that's put into the bylaws of the corporation that overrides that. And as soon as you start taking external money, they're going to be changing the bylaws of your corporation. So it doesn't automatically really continue to work that way, Your bylaws are going to get little things like saying no helicopters. That's one of the best, clauses, this money invested in this company for medical research and no helicopters, and any expenditure over a certain amount or with that is not in these categories must be approved by the board, But one of the things that's going to happen is it's going to delineate what the classes of stock are and what the rights to each of those classes are. So So don't make any assumptions about that. Your individual dealer situation would have to be looked at. Okay, next.
All right, do we have any more questions while Doug is on a roll?
Hey, I'm here. What's the thing in the I'm here all night. Try the fish.
Be here all week.
Be here all week. That's it.
Yep. So if no more questions, thank you so much. Thank you to everybody who joined. Wendy, would you like to do a poll? We still have people who could vote. So if you could please fill out this poll
I like
to know how we
the
did.
host and panelists cannot vote. That's good. No sitting there putting your thumb on the scale.
Right. You cannot say that it was fantastic, Doug.
It was okay. The coffee was good.
All right. So if you could please fill out the poll to help us evaluate workshops and help us improve, that would be fantastic. Also, if you have any suggestions on any future workshops that Doug could, if there are any specific questions that you have, if you would like to have them explored any more in depth, please feel free to contact me or Wendy. We'll be in touch. Thank you so much, Doug. Thank you for staying over time, and thank you to
no trouble.
all the attendees who stayed over time, and thank you for everybody who submitted the vote as well.
Thanks, guys. See you later.
Thank you.